Here's what nobody tells you when you're young. The financial decisions you make in your 20s, 30s, and 40s don't just determine what you have later. They determine what you're able to do later. And most people discover this too late. They hit their 50s and realize they've been great earners and mediocre builders. Today, I'm going to fix that by giving you a clear picture of what matters most in each decade and what mistakes to avoid along the way. I'm Reza Zamani, founding partner and CEO of Steel Peak Wealth. I've been doing this for over 25 years, working with people at every stage of their financial lives. What I've learned is that each decade has its own unique leverage point, its own set of moves that matter most. The mistake people make is trying to apply one-size-fits-all advice to a situation that actually changes significantly as you age. So let's walk through it decade by decade. Your 20s are your most powerful decade, not because you have the most money, you almost certainly don't, but because you have the most time. And time, in the world of compounding returns, is worth more than anything else. The math is simple and staggering. A dollar invested at 25 is worth dramatically more at 65 than a dollar invested at 35. We're talking about a difference that can be measured in hundreds of thousands of dollars on a single investment. That's not hype, that's arithmetic. So in your 20s, the number one move is to start, even if you're starting small. The specific priorities in your 20s are this. Get your employer match first. If your company matches 401k contributions up to, say, 4% of your salary, and you're not contributing at least 4%, you are leaving free money on the table. Full stop. After that, open a Roth IRA. In your 20s, you're likely in a lower tax bracket than you will be at any other point in your career. That makes the Roth incredibly advantageous. You pay taxes now at a low rate, and everything grows and comes out tax-free later. Max it out every year you can. Even $100 a month into a Roth at 22, invested consistently over 40 years, can grow to something remarkable. The other critical move in your 20s is to keep your lifestyle inflation in check. This is the decade when people get their first real paychecks and immediately upgrade everything: the apartment, the car, the wardrobe. I'm not saying live like a monk. I'm saying be intentional. Every percentage point of income you can save now has a compounding effect that no amount of catch-up investing later can fully replicate. Learn to live below your means while your means are modest, and carry that habit forward. Your 30s are when the game gets more complex. Income typically rises, life gets more expensive. Mortgages, kids, career decisions, all of it converges at once. The biggest financial risk in your 30s is letting lifestyle inflation eat everything your rising income generates. I see this constantly. Someone goes from making $80,000 to $200,000 over the course of their 30s, and their savings rate barely moves because every income increase got absorbed by a bigger house, nicer cars, private school, and expensive vacations. Don't let that be your story. In your 30s, you should be maximizing your retirement contributions, not just the match, but the full 401k limit if you can. You should be building a taxable investment account on top of your retirement savings. And if you own a home, you should be building equity strategically, not necessarily paying down a low-rate mortgage aggressively, but also not treating your home like a revolving line of credit. Your 30s are also when disability insurance becomes critical. You are at peak earning power and peak earning need. If something happens to your income, everything else unravels. Disability coverage is the most under-owned protection in America, and it's something I discuss with virtually every client in this stage of life. Term life insurance also belongs in your 30s if you have dependents. The cost is low when you're young and healthy. Lock it in. Estate planning, a basic will, healthcare directives, beneficiary designations should be in place by the time you have kids, not after. I know this stuff isn't exciting, but it's the infrastructure that protects everything you're building. When my kids were young, I made sure all of these pieces were in place. It wasn't just about protecting my family in a worst-case scenario. It was about having clarity. Knowing the structure was solid allowed me to focus on growing the business without a constant nagging worry in the back of my mind. That peace of mind is underrated as a factor in good decision-making. Your 40s are the decade of optimization. If you've played the previous decades reasonably well, you likely have meaningful assets accumulated. Now the work shifts from pure accumulation to intelligent allocation. Questions like, am I diversified appropriately? Is my asset mix aligned with a retirement timeline that's now closer? Am I maximizing every tax advantage available to me? Do I need to increase or adjust my estate plan given growth in assets? Your 40s are also when alternative investments and more sophisticated strategies often start making sense. Private credit, real assets, tax-efficient portfolio structures. At Steel Peak, this is where our conversations with clients tend to get the most detailed because the decisions made in the 40s have a direct and significant impact on how much wealth you actually arrive at retirement with. If you're in your 40s and feel like you're behind, I want to be honest with you. You have more runway than you think, but it requires urgency. Catch-up contributions are available starting at 50, And starting to maximize contributions aggressively now, while reducing unnecessary spending, can close a significant gap. I've seen people completely transform their financial trajectory in a focused decade of effort. It's absolutely possible, but it requires honesty about where you are and a genuine commitment to change. The through line across all 3 decades is the same. Time is your most valuable resource, and the best thing you can do is use it intentionally. In your 20s, start and stay consistent. In your 30s, keep your savings rate growing alongside your income. In your 40s, optimize and protect what you've built. And through all of it, work with professionals who can help you avoid the costly mistakes that derail people at every stage. I want to close with something I say often because it matters. Comparison is a trap at every stage. In your 20s, don't compare your early portfolio to your peers who are spending everything and looking successful. In your 30s, don't compare your progress to the highlight reel version of someone else's finances. In your 40s, don't let a sense of being behind paralyze you into inaction. The only relevant comparison is between where you are today and where you want to be. And the only path between those 2 points is the consistent application of the right principles over time. I've been doing this long enough to know that wealth is not built in dramatic moments. It's built in the disciplined decisions made in unremarkable ones. The automatic transfer set up on a Tuesday morning, the retirement contribution that goes out before you can spend it, the market downturn you survived by staying the course. Those decisions accumulate into something real. Every decade compounds on the one before it. If you're watching this in your 20s, start today. Not next month, not when you get a raise, today. If you're in your 30s or 40s, take stock of where you are and close the gaps before more time passes. Every decade has its moment, and this is yours.